If you're a doctor, dentist, or other high income earner, chances are you've been told the same thing over and over again. Max out your 401k, and guess what? You'll be set for retirement. But let me tell you a quick story. I recently spoke with a dentist. He was probably in his early 60s who followed this exact advice, typically the Dave Ramsey advice. And he spent over 30 years working in his practice, maxing out his 401k every single year, thinking it'd be enough. And then reality hit him. Despite this guy he had over $2 million in his 401k, he realized that he couldn't touch it without paying taxes early on before he was 60. Market downturns could actually wipe out years of gains just like that overnight. And then really his retirement income, it depended entirely on what Wall Street decided to do. He told me, he's like, Jeff, man, I got to the end. I thought I was doing everything right because my advisor recommended this, but now I feel trapped. I'm in my 60s. I still have to work, not because I want to, but because I have to. And I'm sick of working on teeth. And he's not alone. Most people retire much later than they originally planned. Many realize it's too late, that their 401k isn't enough until it's too late. And then few have built really true passive income streams outside of their main W-2 job, their 9 to 5. That's why today in this video, I'm going to break down the 5 things that you need to understand about your 401k before it's too late. Let's get into it. Number 1, your 401k, it doesn't avoid taxes. It simply delays them. It delays your taxes. Okay. A 401k, no matter what you think, isn't tax free. It's tax deferred. And here's what that really means to you. With a traditional 401k, you'll avoid taxes today, but you're going to pay taxes on every dollar you withdraw in retirement. And who decides on that? The government that decides how much you're going to owe. And the tax rates could be much higher in the future. You just never know. But when's the last time anything ever stayed the same or went less? Exactly. Now with a raw 401k, you pay taxes up front, but your money actually grows tax free, and withdrawals are 100% tax free in retirement. Now, here's the issue. Most people assume that they're going to be in a lower tax bracket when they retire. That's what we're told when we have people wanting us to invest in raw 401ks. But if you've really built real wealth, your tax burden could actually be higher, especially if tax rates keep going up, because they probably will. So again, you're not avoiding taxes with the 401k, you're just delaying them. Number 2, here's one of the things that we don't realize that is absolutely draining your 401k year after year after year. It's this good old hidden fees. Yes, whether you believe it or not, your 401k is costing you money every single year because you pay every single year on every dollar you invest, and you pay every single year on every dollar that you earn. And these fees compound over time. They're just eating away every year at your retirement savings. Let me give you an example. Let's say that you invest $1,000 a month in your 401k, and you do this for 35 years because your advisor told you to, right? And you do well, okay? According to them, you average 8%, okay? With a 0.08% expense ratio, you'd retire with roughly 2.26 million bucks. Okay. Just bump that up just a little bit to 1%. You go from 2.26 million to down to 1.81 million. That is and I've already done my math ahead of time, so I'm not this math wizard. That is a $452,000 different. And I'm not talking about going from 0.04 to 2%. I'm just talking about 0.08% just to 1%. That's over $450,000 lost to fees. So your homework is get out your 401k statement and see what you're actually paying. Moving on to number 3, whether you realize it or not, you have almost zero control over your 401k. Let's be honest. Your 401k, you don't get Wall Street, not you, your 401k. So if you want to invest, let's say, in real estate, you can't. If you want to invest in private equity, you can't. And if you want to invest in alternative assets out there, you can't. You're forced into funds chosen by your employer if you're an employee. Now, think about it, if the stock market crashes, your retirement savings, they take a hit. And even worse, your money managers in these funds, they still get paid. Your financial advisor still gets paid. Even if you don't, even if your account goes down, they're still getting paid. What's to lose? Okay. For them. Now, one thing you can do is if you ever leave your job is actually rolling over your 401k into an IRA for more control. Leading us to number 4, your 401k alone. So if the only thing that if you retire on is a 1K, your 401k alone, it won't provide true diversification. All right. A lot of people think that they're diversified. Oh, I'm in stocks, I'm in bonds, I'm in cash, I'm in this and that in my 401k. So they think they're diversified because they have all these different types of funds. But here's the truth. If the stock market crashes, all of your funds crash too. That's not real diversification. Real diversification means you invest outside of Wall Street. Well, like what, Jeff? Well, in assets like my favorite, real estate, cash flowing rental properties, syndications. They're passive, they're hands off. Specifically, RV parks and mobile home parks is what I love. Private businesses, again, not just public stocks, but startups and alternative investments. Look, I'm not anti 401k. A 401k is a great starting point. I started with that. But as your income grows, you should start to branch out, diversify for passive income. Okay, so even though a 401k is a great starting point, it should never be your only plan, which leads us to number 5. The better alternative, in my opinion, the better alternative is this: passive income. Here's what most doctors, dentists, high income earners aren't told. They're not told that the wealthiest people out there, people worth tens, hundreds of millions of dollars, billionaires, they don't rely on 401ks. They focus on cash flow. So if you want to retire early, or at least have the option to stop working or cut back or whatever, you need to replace your income, or you could just replace, like me, you can just go and shoot for your personal expenses. Replace your personal expenses with passive cash flow. That's it. Yet no advisor is going to tell you to do that because it doesn't benefit them. So if this is piquing your interest and you're thinking, that sounds good, but how do you do it, Jeff? Well, again, you can invest in cash flowing assets, like, again, my favorite, real estate syndications. You can own assets that pay you monthly right now. So you don't have to rely on withdrawals in the future. You can get the money now, not wait until you're 59 and a half. And this is going to help you get to the point where you're stop trading your time for money, because that's the thing. All the money and all this and that, that's not this is. If you don't believe me, go ask any rich person out there that's really old. Time is the most important asset. And this, once you get to the point that your income coming in is paying for your expenses, that's what true financial freedom looks like. So to kind of wrap this up, why your 401k isn't enough? Well, again, most people, and I was on the same track until I had my wake up call, hurt my hands, snow skin. I realized I couldn't do dentistry without hands. That was my wake up call. Most people spend decades building their careers, but too many retire without the financial security that they really expected when they started working. A 401k is nothing more than a tool, but it's not a complete wealth building strategy. It's just a tool in your toolkit. And if you want to retire earlier with more financial freedom, you're going to need a better plan than just maxing out your 401k every year. And to see one of the best ways to build passive income through my favorite, real estate investment, real estate syndications, then do yourself a favor, watch this.